Hello everyone. I hope you are doing good, physically and mentally fit and fine. So friends, in this particular video, we are going to see NBFC. So that is the second part of the chapter after bank audit. Let's see guys, audit of NBFC. Just a minute. So when we talk about audit of NBFC, the first thing is what do you mean by NBFC? So NBFC is a company, very simple thing. It's a company under Companies Act, and as name suggests, non-banking finance company. It's a finance company, so major business is finance. It is giving loan to people, financing the projects, making investments, okay, in shares, debentures, bonds. So main business is the finance business. Principal business is finance. Now for this, they may use their own money, shareholders fund. They may use own money, shareholders funds, or they may get money through deposits also. They may get money through deposits. So it's very simple definition. It's a company. Principal business is finance, and they may or may not take deposit for that. So we have NBFCs which accept deposits, and we have NBFC which don't accept deposits. Definitely, it will not include the companies whose principal business is either agriculture or trading or manufacturing or construction and so on. Now, how to decide? Very, very important from exam point of view. There are questions on this. How to decide whether the principal business is finance or not? So RBI has developed a concept called 50-50 test. They have developed a concept. They have developed a concept called 50-50 test. So as per 50-50 test, we have to see last audited balance sheet and P&L. And if more than 50% of the income is coming from, more than 50% of the income is a finance income, finance nature income, and more than 50% of the asset is financial asset. Okay, so if more than 50% income is of financial nature, is from finance business, and more than 50% of the assets are coming from against the finance business, that means loans and advances given and so on. If these two criteria are fulfilled, then we say that the principal business of that particular company is a finance business. Both these conditions are required, then it will be considered as a principal business of finance and it will become an NBFC. So it's pretty simple, straightforward. So now we know what do you mean by NBFC. NBFC is a simple company, principal business finance means 50-50 test, and they may accept deposit, they may not accept deposit. So it does the same thing as banks do. NBFC does the same thing as banks do, but the only difference is banks have lot more liberty. The range of services they give are much more as compared to NBFCs. Like banks can give facility of current account, savings account, checkbooks, okay, online banking, but NBFCs cannot give you these facilities. It's not possible. They won't be able to give you these facilities of current account, savings account, online transactions and so on, online banking. These things you won't be getting. So both do same thing, but in bank we have 100 features. Here we have say 20 features only. Now, as soon as any company fulfills the criteria of finance business, principal business of finance, 50-50 test, they are supposed to get themselves registered with NBFC. Very simple. Get registered with RBI. So if there's any company who plan to do finance business, or any company where they see that they're approaching 50-50 test, they should immediately get themselves registered with RBI. So they will need certificate of registration with RBI. And when they go to RBI, they need to maintain net own funds of minimum 2 crore rupees. Net own funds of minimum 2 crore rupees. So as you fulfill 50-50 test, as your principal business become finance, you become NBFC. Okay. If you plan to become NBFC or you're in process of becoming NBFC, immediately go to RBI and get a certificate of registration. And you are going to need net own funds of minimum 2 crores. If RBI wants, they can increase this limit up to 100 crores. They can increase this limit up to 100 crores. Okay. But RBI has not yet done it. Now, in general, NBFCs need minimum net own fund of 2 crores. If there are different categories, minimum net own 2 crores, but for different set of categories, the minimum net own fund limit is on the higher side. So generally it is 2 crores, but for some category it is 10 crores, or it can be more than that also. So category to category it may change, but in general, for case solving everywhere, we consider only 2 crore only. So these are typical features. These are typical features of this particular entity. We should be aware about it so that when we go for audit, we are comfortable with it. Okay. Now, types of NBFC. We can classify NBFC on different set of criteria. First, from the point of view of accepting deposits. First from the point of view of accepting deposits. Okay. Now, so we can classify from the point of view of deposit. We can classify NBFC in two types: NBFCs accepting deposits and NBFC not accepting deposits. It's very simple, guys. NBFC which is accepting deposits, they're taking public money. More RBI circulars and direction gets applicable. Okay, there are more regulations for such entities because public money is involved. More regulations. If they're not accepting deposits, then comparatively less regulations are applicable to them. Less circulars, directions are applicable to them. But then they are not accepting deposits are further classified depending on asset size. If asset size is 500 crore or more, it is called systematically important NBFC. And the way they write it, NBFC NDSI. NBFC D is accepting deposit, ND means not accepting deposit. The way they denote NBFC. And if the asset size is 500 crores or more, it becomes NBFC NDSI. Definitely, as they become bigger, regulations applicable to them increases, requirement for them increases. Now, when we talk about other NBFCs, okay, if the asset size is not exceeding 500 crores or more, then they are simply NBFC, not systematically, NBFC, they remain normal NBFC ND. So only if asset size increase, they become systematically important. So you can say that not accepting deposits, they are less regulated. Not accepting deposit, but as soon as they become bigger, again some regulations increase. Now, so depending on deposit, we can have two types, and when we say that there are less regulations, again there is a classification, and asset side increases, they go into higher category and more regulations get applicable. Then we can also classify them depending on nature of activities. We can also classify them depending on nature of activities. Okay. Now this is very important, nature of activities, guys. Now, majority of the NBFCs are into financing. They need to get registered with RBI. We are going to see the list. Okay. There's a shortcut. We are going to see the complete list. But then there are some NBFCs which are into activities which are generally governed by other regulators. So they need to get registered with other regulators. Like there are NBFCs like those who are into venture capital, merchant banking, broking. Again, they are somewhere connected to the finance business, but they need to get registered with SEBI. Then there are housing finance, so they need to get registered with National Housing Bank. Okay, so depending on nature of activity, majority of the NBFCs need to get registered with RBI, but then there are some which need to get registered with, did not get registered with RBI because they need to get registered with either with SEBI, or they need to get registered with just like Nidhi company. They need to get registered with MCA or some other board and so on. So guys, we can classify depending. We can classify them depending on whether they're accepting deposits or not. And when they're not accepting deposits, that's great. Further, as per asset size, then we can classify them depending on nature of activities. If the activities fall under the domain of RBI, they need to get registered with RBI. If the activities fall in the domain of other regulatory bodies, they need to get registered with others. We are going to see the list. Okay. Now, sometime back, they did a thing. They said that asset finance company. So the principal business was financing a crane, a truck, or some machine. That's asset finance company. Or company which simply gives loan company, and investment company. There are these three categories. These three categories were merged into one single category: investment and credit company. Investment and credit company, NBFC, ICC, investment and credit company. A very simple classification they came up with. Now guys, I was saying that there's a category, lot of NBFCs need to get registered with RBI. So we have made a shortcut, IFI inaugurated by CM. So there's a film festival. Okay, IFI is the International Film Festival of India. So at IFI, CM is going to explain at IFI. CM is going to explain different types of NBFCs, which are required to get registered with RBI. So I stand for this very famous, the most famous category, investment and credit company. Is a very famous entity. Investment and credit company. They need to get registered with RBI. Majority of the NBFCs fall under this heading. Then F stand for financial holding company. As name suggests, it is not non-operating financial holding company. As on today, RBI says that if you want to enter into banking business, if you want to have a banking license, then you need to have one company which will be only for financial holding, non-operating financial holding company. And then below that, you need subsidiaries. One subsidiary specifically for banking activities, one subsidiary if you want to go into insurance business. Nowadays, banks go into that. Then one more subsidiary which is into securities trading. It is there. Okay. And for every line of business, you need to have a separate subsidiary. That's what RBI wants. RBI wants streamlining. RBI wants a very simple structure. So they say that all the banks, all the new, if any banks want to get registered with RBI, you need to have a financial holding company, non-operating financial holding company, and below that all the subsidiaries will come. So this financial holding company is also NBFC, Principal Business Finance. They need to get registered with RBI. Then F stand for factors, NBFC factors. So if the main work of NBFC is to factoring simply means acquiring debtors. You must have heard about factoring in SFM. You must have heard about it in AFM. Okay, factoring, that there are entities which buy your debtors. They do factoring and give you money immediately. That's called factoring. So NBFCs which finance, which take over the debtors and give money for that, and give money for that. It's a kind of financing. That is NBFC factors. Then I again stand for infrastructure finance company, where the principal work is to finance infrastructure, finance roads, bridges. Okay, so if you want to finance these things, then that is infrastructure finance company. Only 9 such companies were there sometime back. Then, in one more thing in that, I is for infrastructure debt fund. When a debt fund is launched specifically to finance infrastructure projects, that's called infrastructure debt fund. Infrastructure finance company and infrastructure finance companies can do this. They can launch an infrastructure debt fund. Now, no need to remember the name, practical name. So very simple, guys. And then C stand for core investment company. Core investment company, guys. The principal business to finance a particular business house. Principal business is to finance a particular business house. That's called core investment company. There can be core investment company for Reliance Group, for Adani Group, for Birla Group, for Sun Group. Okay, so there can be core investment company. Now, core investment company is not supposed to get registered, but as asset size crosses 100 crores, it becomes systematically important investment company. Systematically important core investment company, then they need to get registered. So in general, they are not required, but as they become bigger, asset size 100 crores or more, they need to get registered with RBI. And then M stand for microfinance company. That's a very big business which is coming up, which is already there, very big business, Bajaj Finserv. So when you give loans into small amounts, 10,000, 20, 50, 60, up to 1.5 lakhs, 2 lakh rupees, and that to an unsecured loan is given to fulfill basically to finance the expenditure of the consumer generally, then that is called microfinance. So it has been observed that these are financially weak people, and they are ready to pay good interest, and they generally don't default. They fear law, they fear legal requirement, they fear police, so they pay their installments on time without any problem. So microfinance is it's a win-win. Local money lenders were charging 100%, 200%. NBFCs are charging 25%. It's a win-win for NBFC also and win-win for them also. So IFI, your investment and credit company, financial holding company, factors, infrastructure finance company, infrastructure debt fund, your core investment company, which is systematically important, that need to get registered, microfinance companies. All of them need to get registered with RBI. Now, there are a range of companies who don't need to get registered with RBI. They are exempted. They are exempted because they are under supervision. They are under supervision of other regulatory bodies. So, just for the sake of retention, I like to group things. Once you group things, you retain more. So we have seen classification depending on deposit. We have seen classification depending on nature of activities. And further, now depending on nature of activities, some need to get registered with RBI, some don't need to get registered with RBI. Now we're looking at that list. What I've done, I have simply again grouped it that there are NBFCs which helps corporates, which generally helps corporate, useful for them, and the NBFCs which helps common man. So that's how I have further grouped them. So in finance, there are two types of functions, either raising finance or investing, either bringing money or investing money. So corporate related, I have said, number one, at venture capital company. So venture capital company, when a new business is started, so that is written, F1. If you can see F1 for a venture capital business. So there are companies which give money to the new business and startups that are venture capitals. They are under supervision of SEBI. So they don't need to get registered with RBI. They get registered with SEBI. venture capital companies. Then as they become bigger, they want more money, they open core investment company. And as they become more bigger corporates, they want to go for IPO, they need merchant banking companies. So initially they need venture capital companies, then they need core investment companies, then they need merchant banking companies. And for investments, again, investments, securitization. You must be aware there's a securitization process. Securitization, any assets, ownership of any asset can be sold to others with the help of securitization. So there's a securitization company. And it distributes ownership of the assets. By issuing securities, and corporates can invest into it. So if corporate wants to invest, there's a securitization company, and then there's an alternate investment fund. Even that is not governed by RBI. That is governed by SEBI. Let's freeze, guys. So when we talk about entities which are exempted from registration with RBI, many of them are for corporates. They help corporates. So initially venture capital company, then bigger than core investment company, then merchant company. And if the corporates have money, you have securitization company. They can have securitization company where investment can be done in securities, which gives you ownership of different assets, or alternate investment fund, AIF. When you talk about core investment company, if asset size is below 100 crores, that is not systematically important. No need to get registered with RBI. Again, exempted. But then as asset size grows, they need to get registered with RBI. Okay. In that also, if they're accepting deposits, then only they need to get registered with RBI. If they're not accepting deposits, they're not taking money from the depositors, again, no need to get registered with RBI. So the asset size is below 100 crores, you are absolutely fine, you are saved. If it crosses 100 crores, then again we have to see whether they're accepting deposits or not. And if they're accepting deposits, it's a big thing, then you need to get registered with RBI. So generally, core investment companies don't need to get registered. Now there are further companies which are generally useful for common man. Okay. Again, common man has two needs, either to raise finance or investment. So if for the finance, if there's a housing finance, microfinance. Sir, microfinance, we have just discussed microfinance. Now guys, certain microfinance companies need to get registered with RBI, certain don't need to get registered with RBI. So it falls under both categories. Some of them need to get registered, some of them don't need to get registered. We are not having details. In our course, details are not expected. So housing finance, microfinance, MGC, mortgage guarantee company. Okay. So very popular is housing finance, then next popular is microfinance, next less popular is MGC, mortgage guarantee company. Nowadays, there are companies which simply do one thing. They give guarantee. They give guarantee and charge fees for that, charge commission for that. They charge commission for that. Now, this mortgage guarantee companies, this expedites the financing process. For example, there's a person who wants to take loan, mortgage loan. There's a NBFC or bank which wants to finance also. But then this NBFC is little worried that whether they can lose their money. If there's a default, they will lose their money. So here comes MGC, mortgage guarantee company. It evaluates the whole situation and it gives guarantee to the financing entity, bank or NBFC, that listen, don't worry, we are giving guarantee. We are giving you guarantee, you give finance to them. So MGC expedites the financing process. Now, because of MGC, mortgage guarantee company, even the interest rate which is charged to the borrower, even that reduces. So that's a new type of entity, and their only job is to evaluate the situation properly and give guarantees. So housing finance, microfinance, MGC. Then for investment, so we have stock exchange companies which are on stock exchanges. Below that, smaller than that, brokers, insurance companies, chit fund, nidhi fund, mutual benefit entities. So for investment, stock exchange, brokers, then insurance, then chit fund need to get registered with state government authorities, Nidhi company with MCA, mutual benefit entities. Again, they generally don't need to get registered with RBI. See, this is just a classification. Overview is given that so many different types of NBFCs are there. So we can classify depending on deposit. That's a big thing. Then depending on nature of activities, many of them need to get registered with RBI. There are some which need not get registered with RBI. We have classified corporate related, common man related for the sake of retention, just for the sake of retention. So there are companies which fulfill corporate needs of finance and investment. There are companies which fulfill need of common man for finance and investment. Okay. So again, the same thing is explained, guys. It is they are regulated by other regulators. So merchant bankers help in IPOs, the IPO process, venture capital, initial financing, secure reconstruction company to sell the ownership of the assets, core investment company for group finance, alternate investment fund to invest money in the instrument, in the opportunities which are totally different, which are of different nature altogether, new altogether, and they take different types of risk. So that is alternate investment fund. They don't do regular investments like listed entities, shares, and they do investments into unlisted entities. Housing finance, if the microfinance, stock exchange, stock brokers, insurance, chit fund, Nidhi, mutual benefit entities. Okay, we already discussed. When we talk about core investment company, if they're small, they don't need to get registered. Okay, if the asset size increases, again see whether they are accepting deposits or not, and then we can decide about the registration. So guys, in NBFC we have seen what do you mean by NBFC. The most important thing is principal business test, 50-50 test. Okay, you need to get registered with NBFC, and then we have seen the classification depending on deposits, depending on nature of activities. Okay, and depending on nature of activities, some of them need to get registered with RBI, some of them don't need to get registered with RBI. Those who don't need to get registered with RBI, some of them are for corporate, some of them are for common man. Now this is the most important thing. See, the same set of NBFCs can be categorized with the help of different criteria. Deposit is one criteria and nature of activity is the another popular criteria. Now, for the purpose of regulation, they have introduced a new classification altogether, and that is extremely important. A new classification altogether, and that's extremely important. What is this new classification? They have divided NBFC into four layers. Base layer, middle layer, upper layer, and top layer. Base layer, middle layer, upper layer, top layer. Okay, let's see this classification. So very important. So there can be a question straight away in exams that identify in which this is called scale based regulation. That as per scale based regulation, in which category a particular NBFC will fall. So let's see base layer. So NBFC which are not accepting deposits. So which NBFCs are going to fall in base layer? So there is a deposit condition. As per deposit condition, not accepting deposit. Okay. There are two criteria: deposit based criteria, activity based criteria. This is deposit based criteria, and then we have activity based criteria. We have deposit based criteria and then activity based criteria. Now when we talk about deposit based criteria, if they are not accepting deposit and asset size is not exceeding 1000 crore, for systematically important the criteria was 500 crore, for core investment was 100 crore, and now here it is 1000 crore. If you are not accepting deposit and asset size is not exceeding 1000 crore, you fall in base layer. You fall in base layer. Okay. Now activity based, if you are into PAN activities, shortcut is PAN, PAN activities. P stand for peer lending. Sir, what do you mean by peer lending? Nowadays there are NBFCs which facilitates become intermediary if one person wants to finance the other person. So there are many, if you just put on Google, you will get the websites for peer lending in India, where you can give money directly to an individual person, individual businesses, with the help of those intermediaries websites. So these entities help from this help in peer-to-peer financing, and these NBFCs, they evaluate proposal properly, they evaluate entities, businesses, everything properly, and then peer-to-peer lending happens. Peer-to-peer finance happens, and the aim is to uh, make use of that gap. So when you give money to bank for deposit, they will give you hardly 6%, and when they give loan to others, they will charge 12%. So they have a spread in between of 6%. So peer-to-peer lending wants to capitalize on that. That bank is earning in between 6%. Why not have a win-win situation? Let's give if the spread is 6%, let's give investor more interest and let's give the borrower, let's charge him less. So both are going to win. This situation may arise. So peer-to-peer lending helps in financing on one-to-one basis. They facilitate, they become intermediaries. Account aggregator. Nowadays we have so many accounts, so many credit card, debit card, everything. So account aggregators, they are basically technology companies. They can aggregate all your accounts, mutual fund, every damn thing under one app to make management easy. So that is called account aggregators. They will also fall in base layer. They are basically technology company providing apps and websites. Then N stand for non-operating financial holding company. We have discussed about it. If their only job is to hold, to become a holding company, financial holding company, that's it. And it is required for, if you're into finance, it is required if you're into finance, if you want banking license, that kind of structure is required. Then N stand for not availing public funds, not having customer interface. So apart from that, if there is any NBFC, it is not availing public funds, directly, indirectly, they are not directly taking money. They are not directly taking money from people. Okay, not directly taking money from people, and they are not dealing with customers directly. They are intermediaries. That means like MGC, management guarantee. So not having customer interface, like account aggregators. Okay, they're simply providing the app. Real beneficiaries are customers, provided are the other NBFC. They're simply aggregating thing. That's it. If you're not directly dealing with customers, your main business is B2B and not B2C. So entities which are not raising money from public, they're not having direct interface with public, they will also fall in base layer. So regulations are at minimum when we talk about base layer. So these entities, PAN entities, always in base layer, always. Peer-to-peer guys, account aggregators, non-operating financial holding companies, not availing public funds, not having customer interface, all these guys will always fall in base layer only. So if you fulfill the deposit condition, you will go in the base layer, or if you fulfill the activity condition, you will go in the base layer. Then we have the middle layer. If you're taking deposit, you go to middle layer. You will go to middle layer. Or you are not accepting deposit, but your asset side is exceeding 1000 crore, you go to middle layer. Definitely guys, base layer, the kind of regulations are at the lowest, regulation applicable. But when we talk about middle layer, regulations increase. Then Saichi is the shortcut. This is activity based. This will go to, these things will always go to middle layer only. Saichi or Shakal is coming, hide immediately. I think Saichi is better. shortcut SAICHI. Standalone primary dealers. Standalone primary dealers. Now, standalone primary dealers means those who are buying and selling government bonds. So those who are buying and selling government bonds, they are they are called primary dealers. Primary dealers. They will always go to middle layer. Always go to middle layer. Okay. They are primary dealers. Then infrastructure debt fund, SAI, it will always go to middle layer. These two always go to middle layer. Chi, that is core investment company. There's a question on this. There's a question on this. It will be careful. Very important question on this. Okay. When we talk about Chi, core investment company or core investment company or housing finance company or infrastructure finance company. See, debt fund was in SAI, infrastructure finance companies in Chi. They may go to middle layer or upper layer. So what is upper layer? If you are into top 10 NBFCs of India, you go to upper layer. If you're not into that, you go to the middle layer. So Chi, core investment companies, housing finance companies and infrastructure finance companies, they go to middle layer, guys. SAI, these two will be always middle layer. Chi can be in middle layer, and if they fall in top 10, they will get promoted to the upper layer. Top 10 NBFC as per asset size, always they will go in upper layer. Apart from this, RBI can set more parameters. So guys, small ones go to base layers, then little bigger ones, they go to middle layer, and out of that, if they're in the top 10, they go to the upper layer. Now, there's a top layer. Ideally, it is going to remain empty. There will be no NBFC here. But if NBFC become very big and it has become little risky, it can collapse, and it is having systematic risk. That means it can affect the whole finance business of India. Then, if that is the case, then that will be promoted to top layer. A special care will be taken of such finance companies. That is top layer. Okay. So for the purpose of monitoring, we have base, middle, upper and top. Extremely important. Government owned NBFCs, either they will be in the base layer or middle layer. They will never go to top and upper layer, because they feel that government owned entities, no need to worry a lot. Already government administration is there. Never take them to the upper or top layer. So that's very important, guys. There can be simply question that this is the NBFC, these are the details. Tell us, depending on deposit or activity, whether they fall in base layer, middle layer, upper layer, top layer. So if we differentiate between banks and NBFC, if we differentiate between them, when it comes to source of finance, banks, FDI limit, NBFC, it is 100%, banks, it is 74%. So it's positive thing in NBFC. Then one positive, one negative. Banks can give, NBFCs cannot give demand deposit facility, banks can give it. When it comes to facilities, banks can give check, demand draft, NBFC cannot. So when it comes to facilities, further, if the money is deposited with NBFC, with bank, then it is covered by deposit insurance. So up to rupees 5 lakhs, if suppose bank collapses today, if you have deposit up to 5 lakhs, 5 lakhs will be insured. You will get 5 lakhs from the RBI, from the government. You don't need to worry. But this facility is not there with NBFCs. Okay. So if you want to be safe, you should invest in banks and not NBFCs. Obligations and powers. So there is the obligation bank compulsory lending to priority sector. That's not the case with NBFC. So there is a positive in NBFC but negative. Do not have power under SARFAESI or DRT, Debt Recovery Tribunal. Okay. So DRT and these facilities will not be. So guys, when we compare with bank, source of finance, one positive, one negative. For NBFC, Obligation power, one positive, one negative. Okay, facilities negative. They cannot give facilities like bank. So guys, now we know what are NBFCs, what are the criterias, then to get registered, the types of NBFCs, depending on deposit, depending on activity, and then we have base layer, middle layer, upper layer, top layer. It is extremely important how NBFCs are different from bank. Now we next go to, guys, prudential norms. Okay, just a minute, guys. Just okay, guys. Let's see. Now we got the important part. What are prudential norms? As name suggests, guys, as name suggests, prudential norms, RBI has made norms so that activities performed by the NBFC should be prudential, should be conservative, and the way they do, the way the activities performed by them, the accounting done by them should be on the conservative side. They should be careful. Being prudent means being careful. Being careful, that means to recognize losses and issues as you come to know about it. Be uh, be aggressive, be very strong in recognizing losses, okay, and then be be very optimistic in recognizing losses and problems, issues, expenses. Be little pessimistic when you talk about booking your incomes and so on. Okay, so prudential norms are the norms how NBFCs should act, how NBFCs should do accounting, so that they are safe and secured, they are prudent. To keep them prudent, to keep them conservative, to keep them financially sound, prudential norms are there. And in that, we are discussing a particular thing, capital requirement. We have seen this in bank audit, the concept of capital adequacy ratio or capital to risk weighted asset ratio. Exactly copy paste same. Capital shows loss bearing capacity. More is the capital, owners can bear more losses, less chances that loss will be borne by the depositors and other lenders. Same goes with NBFCs. They should be financially sound, they should have enough capital. So there are directions issued, especially for NBFC taking deposits and NDSI. Those who are accepting deposit and those who are not taking deposit, but they are into SI category. Then in that case, minimum capital adequacy ratio, CRAR, should be 15%. When you talk about banks, it was only 9%. Now here they're talking about 15%. Okay. That too, they're further specifying that tier 1 capital. We know that in capital we have two. The very pure capital is tier 1 and tier 2. It's saying that tier 1 contribution should be 10%. Tier 1 contribution should be 10%. So tier 2 can contribute only up to 5%. Then we talk about gold loan NBFCs, those NBFCs which give financing on the base of gold. Okay, Muthoot Finance on the base of gold. They should have tier 1 capital contribution of 12% for the requirement. So in general, for big NBFCs, it is 15%. Tier 1 should contribute 10%. And in case of gold loan, NBFC should contribute 12%. Tier 1 capital should contribute 12%. So capital wise, prudential norm says that capital wise they should be very strong. When it comes to income recognition, they should be again very careful. Generally, they follow accrual basis, but as a loan advance becomes NPA, then they should reverse all the accrued income. We already studied this in back, accrued income, and shift to cash basis, nothing new. So capital wise, they should be strong. Income recognition wise, they should be very careful and strong. Then Non-performing asset. So just like we had this in bank on the same lines. Okay, in general, if the NBFC has given any kind, if there is any kind of asset and any case of asset loan, amount remains overdue for a period of more than, for a period of 3 months or more, 3 months or more, NBFC, it will be non-performing. Listen, if you study our ICS study material, you will see they have uh, the time period given is different, but then if you read more, then they put a star mark and they said replace 6 months by 3 months. You will see that in our module 6 months, 6 months, 6 months is written, and then there's a star mark, replace 6 months by 3 months. So ultimately it is 3 months only as on today. So if any amount is overdue for 3 months or more, NPA. Same thing is applied. Term loan, installment of principal interest is overdue 3 months or more. Short-term loans and advances remains overdue for 3 months or more, NPA. Bill purchase after due date, amount is overdue for 3 months or more, NPA. Demand loan after after asking for money, from that date, amount remains overdue for 3 months or more, NPA. Okay. Then any dues on account of sale of assets. You have sold assets or given services, rendered services. Okay. And you have not received the money for 3 months or more, NPA. Hire purchase lease, not getting money, NPA. And it will be borrower wise. If one account of borrower becomes NPA, then in a particular NBFC, if one amount become NPA, all other amounts given to that borrower will become NPA. Guys, it's very simple, pretty simple. Anywhere, if amount remains overdue for 3 months or more, you're not getting, 3 months or more, NPA, you're supposed to get money immediately, but then 3 months or more, NPA, very simple, 3 months or more, NPA. So in NBFC, keep this in mind, non-performing assets will be there if it's 3 months or more. So they are giving glimpses of prudential norms. They're prudential norms for capital, to keep capital strong, for income, for NPA. And in NPA, there is a further classification. Again, we know, same in banks. If asset is all fine, it is called standard asset. It is called standard asset. In NPA, there is a first category. For 1 year, it will remain in substandard asset. Then it goes to doubtful. In doubtful, we have up to 1 year, 1 to 3 years, more than 3 years. And if, as per market reports, all the information, they won't be able to pay money, borrowers, then that is loss asset. So if there is no default, everything is fine, it is a standard asset. If it has become NPA, the first category is substandard assets, and it is going to remain there for 12 months. If there is no recovery for 12 months, if it doesn't come out of that, not exceeding 12 months is going to be there. In fact, if the loan is renegotiated, rescheduled, or restructured after commencement of operation, so rescheduling has happened, okay, then you will need satisfactory performance to come out of NPA. You will need performance of for 1 year, you should pay all the amounts regularly, then only you will come out of the NPA. Otherwise, you will remain in substandard asset. They're saying that. So if the rescheduling, renegotiation, restructuring has happened, even after paying all the overdue amount, for 1 year it will remain in substandard, then only it will come out. Be conservative. It can be asked in MCQs, guys. This can be asked in MCQs. Then doubtful assets. Then we talk about doubtful assets. So doubtful asset, what are these doubtful assets, guys? Pretty simple, straightforward. Okay. If after 1 year, substandard, it will go to doubtful. Okay. An asset which remains substandard for 12 months, it will go to doubtful asset. An asset identified loss asset for its internal external auditor or by RBI during the inspection to the extent is not written off. If you find that as per the information explanation that it's very difficult for the party to give money, okay, either internal auditor, external auditor, RBI, external auditor, internal auditor, or bank themselves, NBFC themselves have identified that An asset which is adversely affected by potential threat of non-recovery due to their either erosion in value of security, non-availability of security, or any fraudulent act or omission on part of the borrower. So, if any of the entity identifies that it will be difficult to recover money, it's a loss asset. Any of them can identify. And if there potential threat of recovery, okay, we have studied this in bank audit, potential threat of recovery at the same time as erosion in value of security, it will also go to the loss asset. So, if any authority identifies its loss asset, it will go to loss asset. And if potential threat plus erosion, it will again go to loss asset. Provisioning requirement. This can be asked in exams. How much provision should be there? This can be asked in MCQ also. Okay. So when we talk about guys, when we talk about standard asset, it is 0.35% now, which is changed to 0.4%. Very simple, 0.4%. Substandard, if it is a secured portion, okay, substandard 10%, substandard in general 10%, then doubtful, secured portion of doubtful 20%, 1 to 3 year 30%, more than 3 year 50%, 10, 20, 30, 50, 10, 20, 30, 50, okay. Unsecured portion will immediately go to loss, and loss asset will immediately go to 100%. So, when we talk about secured, it is 10, 20, 30, 50. 10, 20, 30, 50. Okay. In case of banks, I am saying, banks, it is so in case of banks, they are pretty strict. Banks, they are pretty strict. 15, 25, 40, 100. But here they are less. So you can remember in that way. It is 10, 10, 20, 30, 50. 10, okay. That is, this is for banks. This is for bank, and that too secured. When we talk about bank unsecured, it is 25 and 100. But in NBFC, it is 10 and 100. So you can simply remember that NBFCs, the provisioning requirement is quite less as compared to banks. As compared to banks, there can be MCQ question on this. Again, same thing in banks, the provision for NPA need not be made from gross advances. It will be shown separately in contingent provisions. Same things happen in bank also. That provision for NPA is shown separately. In NBFC, it will be shown separately. Now, guys, we start with the audit procedures. Guys, it's in a flow. Now, from here onwards, guys, there's a flow out there. You simply catch the flow. You cannot remember and cram everything. Just remember the flow and try to give those headings and explain in your own words. Okay. So general audit procedures, the most important when auditor goes to audit of any NBFC, irrespective of deposits, any NBFC, irrespective of deposits or nature of activity or scale-based classification, these audit procedures should be done for all NBFCs. The first thing you should go to is, you should go and check certificate of registration. Whether NBFC has obtained a proper registration, certificate of registration, COR, certificate of registration from RBI. That's the first thing. That's common sense. The next important thing is you need to understand their business. So go and read MOA and AOA. From there you will understand. From there you will understand what is in MOA and AOA they must have written what is the purpose for which this NBFC was incorporated. So go and read MOA and AOA. You will understand their objective. You understand their main business. Then further go and read their business policy. That as per policy, on which sector and what kind of financing they are focusing more. Are they into loans? Are they into factoring? Are they Are they into investments and so on? So first MOA, AOA, then business policy, then go and read minutes. What kind of thing they discuss more? What kind of thing they're approving? So the big is MOA, smaller than that, business policy, smaller than that, minutes. And then independently in market, ask to people and observe yourself what kind of activities they do. So first you said that let's ensure that they have valid certificate of registration. Then let's understand their business through MOA, below that their policies, below that the minutes and independent collaboration. Then next is internal control system. Very important thing, when you deal with finance, you need very strong internal control system, whether it's receiving money or giving money. So it is management responsibility to establish internal control system. Sound system is going to ensure that it's going to prevent, detect frauds and errors. Audit is supposed to obtain understanding. So first to explain importance of internal control, and management is supposed to do it. It will ensure, it will prevent, detect frauds and errors. As the auditor, we are supposed to understand, when we go to entity, understand entity and the environment, including internal control system, we need to understand how good system are. We need to check, are the systems operating properly, because that's going to affect our audit process in future. So first you focus on certificate of registration, then next you focus on business, then next you focus on internal control systems, then next you focus on source of money if it is accepting deposit. So go and see the board resolution, whether they will be accepting deposits or not. From there you will understand whether it is a deposit accepting NBFC or not deposit accepting NBFCs, and see whether whatever resolution they have passed, whether the same thing is done, whether they are following it throughout the year. If they are, go and see whether they are accepting deposit, yes, and okay. So go and see the board resolution to understand whether they are accepting deposit or not. Now guys, it's in a logical sequence. Now once you ensure, okay, they are into accepting deposits, whether they have gone before raising money through deposit, they need to go to credit rating agency. Whether they have gone to credit rating agency and whether they have done credit rating for themselves, it is mandatory to go for credit rating before you accept deposits. Why so? Because because the amount of deposit depends on credit rating. So first go and see board minutes whether they are accepting deposits. If yes, then go and see whether before accepting deposits they have gone for credit rating agency, credit rating, because credit rating it is going to decide what is the volume of deposit, maximum limit of deposit they can accept. Depending on credit rating, the deposit limits increase and decrease. Then next, they should ask for written applications, preferably in the standard format. They should ask for written application and written forms when they accept deposits with all the details. Then they should, once they get the deposit, they should maintain the register, the details of the people, person, the date, the amount, the terms and conditions, the maturity, everything should be recorded on the deposit register. Okay. Then they should maintain liquidity. Once they accept deposit, it's in they maintain liquid investments, so that whenever if any depositors comes for repayment, they should be able to do it. Okay. Then regularly interest should be calculated and paid to the depositors. Go and check that. Then after that, at year end, file annual return, how much deposit you have accepted and how you have treated them. Are you doing are you fulfilling all your responsibilities? Finally, further at year end, submit accounts, audit report, director's report. These are very common things. Financial statement, then audit report, then director's report. So if you are an NBFC accepting deposit, first go and see board resolution, then the credit rating, limits as per that, then written applications, then the registers, then the investments, liquidity should be maintained, then the interest should be paid on regular basis. At year end should be annual returns and accounts, audit report, director report. It's in a flow, guys. Again, it's in a flow. If you catch this flow, it will be easy to remember. Now, they may ask in general audit procedures. So you are supposed to write about certificate of registration, business and internal control systems. The next is all the NBFCs are supposed to follow prudential norms. Prudential norms are there just to protect the NBFCs, keep them safe and sound. So now, see, we have already seen prudential. We have seen specifically what prudential norm says about capital, what it says about income recognition, what it says about NPA classification, and so on. We have seen that. Now, further, they are saying when you go to audit of NBFC, it is a general audit procedure to check compliance of prudential norms. So again, what kind of things prudential norms say? Prudential norm says that you should have a defined policy. If you want to give money, you should have a strong policy. There should be a strong policy with respect to giving demand and call loans. These are very risky loans, demand and call loans, that they will pay money only when you ask for it. There are big chances wrong things happen, money is lost. So there should be very strict, well researched policy for demand and call loans. Then, so when you are giving money, so there should be very strong policy when you are giving money as demand loan. Further, whenever you are going for investing, going to give advances or investment, it's very important that first ensure that you have repaid all your deposits, then only you can go for. First you repay your deposits, then only you can go and give advances and investments. And it can be never be on the basis of own shares. The same is applicable to bank also. First ensure you have repaid deposit. Next, it should not be on the basis of your own shares. That's not allowed. It will lead to circular financing. You will give money, then they will invest in your shares. Again, you will give money. We don't want circular things. Okay. Concentration of credit, very important. If you're giving loan to any company, it should not exceed 15% of own funds. And if you're giving to the whole group, it should not be 25% of the whole group. It should not be more than 25% of the whole group. If you're investing, again the same limit is applicable. It should not be 15% for single entity, and it should not be more than 25% for the whole group. And if you're doing both, you are giving loan also and you are investing money in the shares and debentures, securities also, then combined should not exceed 25%, and for a group it should not exceed 40%. So they are not doing simple addition. If you're doing both, the ultimate percentage is on little lower side. If you're doing both in a particular company, it is 25-40%. There should not be concentration. To keep NBFC safe, there should be strong policy for demand and call loan. There should be, then you should be careful. First repay deposits, then only you can go for loan or advancing or giving advances or investments, not on the basis of own shares. There should not be concentration. After giving advances, income should be recognized on accrual basis, and if it becomes NPA, it should be accrued income should be reversed. It should be shifted to cash basis. Dividend should be booked when right to receive arises. These are very prudential, simple norms. Mutual funds on cash basis, we discussed this in bank audit Q&A also. In case of mutual funds, go for cash basis, because whatever they earn is automatically reflected in NAV and it gets recorded and recognized in books of accounts. So no need to do anything separately. Only when they pay you money, you need to account for it. Then we talk about asset classification. End of the year, depending on recovery status, performing, non-performing. Make provision for it. Then capital adequacy norms we have discussed. Investment should be valued as per the criteria given by RBI. So guys, when it comes to prudential norms want to keep NBFC safe and secure. So they talk about sources of finance and investments. Okay, when they talk about sources of finance, they talk about capital. Minimum capital requirement is there. Capital is the most important requirement when it comes to source of finance. Okay. When it comes to putting money, when it comes to investments, there's a very important which is applicable to loan also, that there's a concentration criteria. When it comes to advances, first ensure deposits are paid. That's how you can remember, not on the basis of own shares. After advancements, about income recognition, NPA classification and provision, and then investment valuation also. So you think about the balance sheet. you think about the liability side, you think about the asset side, automatically you will recall the prudential norms we are supposed to check. So there can be question what prudential norms you should check. There can be a separate question. If it's a core investment company, it is for a particular, it's finance particular group. Go and read board minutes, you'll understand whether they're accepting deposits or not. It is for a particular group. Okay. As an auditor, you should check. There are a lot of criteria. That's not in the course. There are a lot of criteria that you can be called as a core investment company. Then there are criteria to remain. Then there are criteria. If you're not exceeding 100 crores, no need to get registered. Exceeding 100 crores, if you're not accepting deposits, no need to get registered. So go and see board decision, whether they're co-investment company, which particular group is there. They understand whether they're fulfilling all the criteria for core investment company, and then criteria to remain unregistered, and so on. So guys, those were general audit procedures. General audit procedures. And in that, one thing I would like to say, talk about deposits when they specifically ask for it. Talk about deposits and talk about, write all the general audit procedure. Talk about deposit only when they ask for it. Otherwise, the rest of them will be fine. And guys, I understand it's pretty long. But then as I said, I know it is pretty long. But then as I said, guys, if you are in a flow, you will be able to remember this. Now, this is very important. The classification of frauds. So if frauds happen in NBFC, NBFCs have to report it to the RBI, and they have to put it in this particular classification. And the same kind of classification is applicable to banks also. Let's see, guys. Now, classification. Now classification of frauds. So if fraud happen, we need to classify in one of the categories and then send it to the RBI. So let's have a very simple example. So a person was supposed to collect cash and bring it to NBFC. So Mr. A was supposed to bring cash and give it to NBFC. Mr. A, he runs away with the cash. This is misappropriation and criminal breach of trust. This is one category. So Mr. A was supposed to bring the cash. He runs away. Misappropriation, criminal breach of trust. Then next, Mr. B was supposed to receive the cash and put it properly and account it properly. If Mr. B is not receiving the cash properly, not doing proper accounting, and because of that there's a difference in books of account shortage, it is considered negligence, and cash shortage is one category of fraud. Then next, Mr. C was supposed to take this money and make payments to customers whenever they ask for money. Supposed to make payments. He makes payments on the basis of forged instruments, or he himself manipulates and withdraws money. Again is a type of fraud. Then Mr. D was supposed to give loan out of this money. Okay, he accepts illegal gratification, he accepts bribe, and on that basis he gives money. On that basis, illegal gratification, on that basis he gives money. Again it will be considered, it's a category of fraud. Then people come from outside, they submit fake documents and fool NBFC. That's called cheating and forgery. That's again a category of fraud. See, it's in a sequence, guys. Mr. E comes and fool people, one of the categories. Then finally At the end, whatever was the fraud money, it was converted to foreign exchange. So if the irregularity in foreign exchange transaction, it is one category. Okay. See, the simple is Mr. A was supposed to bring money. He doesn't. Misappropriation, criminal breach of trust. Mr. B was supposed to do the accounting, that didn't do it properly, negligent, shortage, again. Mr. C was supposed to make payments out of it, forgery, illegal manipulations, again. Mr. D was supposed to give loan out of it. Okay, again there are problems, there's a kickbacks, bribes, illegal. Then people who come, they are fooling us, cheating, forgery, and then at the end everything is converted into foreign exchange. There is one more. So these are classifications. This can be asked, this is asked as theory and any other. Negligence and cash shortage and irregularity in foreign exchange are not reported as fraud if the intention to cheat, unless the case of negligent cash shortage, irregularity in foreign exchange transaction referred to in this item are to be reported fraud if intention to cheat is proved. So they are little soft on the requirement. Only when there is an intention is when there is an intention to cheat, then only you declare it as a fraud. But then they say that further, in case of cash shortage more than 10,000, assume there is an intention to cheat. If it is more than 5,000 and it is detected not by the cashier, by the auditor or inspecting officer or the management, again it is assumed as deemed as a fraudulent intention. Same classification is applicable to branches also. They also need to report frauds as per this classification. So this classification is for reporting fraud to RBI. Now guys, so we have seen the general audit procedure. And then now specific audit procedure. How to do audit of a investment company, loan company, hire purchase company. Guys, it is pretty simple. There's a complete, just imagine the kind of activities they do. Mnemonic for class. Okay, there can be just a minute, guys. Now, so you can remember this small story. I find it very convenient when said, okay, Mr. A was supposed to do this, Mr. B was supposed, first money will come, then it will be stored and accounting will be done. Then out of that payments will be done, out of that loans will be given. Then borrower may fool, and then foreign exchange. So I remember in that flow, okay. So I can see that money CUF, can also be a mnemonic for that. So definitely you can have a mnemonic also. Now, the key to success out here is that it's in a flow, guys. It's in a flow. If you remember that flow, it will be very easy to remember. Very, very easy to remember. So first they're talking how to do audit of investment business, then how to do audit of loan business. They may ask investment business. See, what in ICC both businesses are under one category. ICC is okay, investment and credit company. So investment and credit means loan. They've clubbed it. So before that, there were separate investment points, separate loan points. So what they simply did, okay, first investment points and then loan point. Anyways, guys, let's freeze. If you want to do audit of the investment business of NBFC, what are you going to do? What the first thing which happens? Buying and selling of investment. First thing which happens is buying and selling of investment. You talk about that. Whether board resolutions were passed, go and see board minutes where proper board resolution were passed for buying and selling investments. Okay, buying and selling investments, or obtain a management certificate. Yes, we approved it. Buying and whether board minutes were there for buying and selling investment. Also see what is the intention of the investment, long term or short term, and you can take a written representation also for the same. So first ensure proper decisions were taken. Then for execution, you need brokers. Brokers, whenever they execute things for you, they send contract note. Whenever a buying selling happens, contract note will give all the details. This is the investments, this is the quantity, this is the rate, this is the brokerage, everything. Go and check whether there are contract notes. On monthly basis, they are going to send bill. So check that also. Now, check few things at the time of purchasing. Check few things at the time of purchasing. If it's a subsidiary or a group company, whether shares are properly valued, whether proper valuation methodology was used, proper methodologies and assumptions were used, and it is not biased. It was not biased. There is no overvaluation or undervaluation. Then, at the time of investment, if you're investing into unquoted, unlisted debentures and bonds, and if you feel that, okay, we are the major investors and it is for a particular project and it is named as a debenture bond, but all the feel we are getting is like project financing. More than 90% we are investing and it is the money is used for project finance. It is like giving project loan. So instead of treating it as an investment, it should be treated as loan. So while buying investments, see whether valuation is proper. If it's a group company or a subsidiary, then you go and then you go and see whether unquoted debentures and bonds are there. Okay, that may be in substance, that may be in substance, guys, a loan. So be careful, and then also be careful about concentration. So first you talk about what things happen first, buying and selling, verify that. Then at the time of purchasing, ensure that valuation is proper, especially group company, subsidiary. Then ensure that whether it is in nature of loan and there is no concentration. After buying, you'll start earning. Very simple. Then you check that income is recognized on all the investments. If it is the shares, dividend should be booked when right to receive is established. If it is debentures and bonds, interest should be booked on accrual basis. But if it become NPA, non-performing investments, if it becomes non-performing investment, non-performing investment, then that case we reverse the accrued thing and shift to cash basis. And on mutual funds, it is on cash basis only. So simply explain how dividend and interest should be booked. Then you talk about year-end verification. If the physical, very simple, we have discussed in bank also, if the physical securities are available, go and physically verify it. If it is in demat form, see the DP statement, depository statement. If it is with the custodians, get external confirmation from them. Get the external either it will be physical, either it will be custodian, get the confirmation, either it will be in dematerialized form, get the statement from depository. Then you talk about valuation. Now, RBI gives valuation norms for investment, follow that. If they have not specified it, we need to simply follow AS and Indias. Okay, AS and Indias need to be followed. For big NBFCs, Indias is applicable. For small NBFCs, AS is applicable. For big NBFCs, Indias. Guys, these are the key points you're supposed to. It's in a flow. First happens buying, selling, then at a time buying few things, then comes the income point, a very simple income point which is repeated again and again. Then about the verification, valuation. Then these guys can get into one more thing, borrowing and lending securities. Borrowing and lending securities. Yes, guys. Now, what is this borrowing and lending securities? In this, one more business they can do is, suppose they have shares and debentures. They can lend it. They can lend their shares and debentures. Okay, use it for 1 year, 2 years, and give it back with all the benefits. Okay, as such, they are lying with us. You take it, you use it, and give it back, and they will get some 3-4%. That's the additional income, guys. That's a wonderful thing. Lending your securities is a long-term securities can be lent, and you can earn more money on that. You are going to have your debentures and bonds after a few years. That's fine, and you will be getting some additional returns also for that. So see, when you lend, are you getting it back, the same securities, and whether proper charges are recovered? At the same time, if you borrow from someone, when you are returning the same thing and you are paying charges also. So first you talk about buying and selling, then the buying condition, then you talk about the earning, then you come to year end, you talk about physical verification, and valuation. Okay, then you talk about lending. Now when it comes to loan company, guys, pretty simple flow is there. See, this is the flow. Simply follow this flow. That if you want to check a business of loan company, first go and check whether there is proper first go and check whether credit worthiness of the borrower was properly evaluated, studied, analyzed, and on that basis, whether it was proper evaluation was done. Okay, then if it was all good, then whether it was properly authorized. After authorization, whether proper documentation and agreement were prepared, then security was received, ensure that the legal titles are clear, it is having proper valuation. Okay, you cannot have your own shares, you cannot give on the basis of own shares. Then ensure that proper margin was deducted, then ensure proper disbursements are done, ensure that it is used for proper purpose, utilization, interest is charged, repayments are happening on regular basis, properly accounted for. Year end, take the confirmation. If there is irregularity, it should be properly classified as per NPA norms, and there should be provision for NPA. Guys, it's pretty simple. If you are going to check the loan, if you are going to do audit of loan company, select loan accounts, big loan accounts, and then randomly other. First, proper credit worthiness, then proper authorization, then proper documentation and loan agreement. After that, security, legal value and valuation, not own shares, then margin deductions, then disbursement, then utilization, then interest should be charged, then repayment will happen, then year-end confirmations, NPA classification. This is the flow in which activity, and simply go and talk to about it. Give heading, write 1 2 line, give heading, write 1 2 line, give heading. That's audit of a loan company. We need to imagine what activities they do. And that's it. Then we talk about hire purchase company, guys, on the same lines. Hire purchase, same points are applicable to hire purchase company and leasing company. Common answer. So first go and check MOA and AOA. First go and check MOA and AOA. MOA and AOA, whether they have in their object clause clearly written that they can do hire purchase business and leasing business. Hire purchase business and leasing business. Okay. Then do they receive proper? They have received proper proposal for hire purchase lease in a proper format with all the details. Then whether the credit worthiness properly evaluated. Then whether there was board of directors approval for that particular asset or crane or whatever. Okay, board approval. Then proper agreement and documents were prepared. then we need to get, we are a hire purchase leasing company, cash down payment. In agreement, there should be all details. Who are the parties, what asset we are talking about, what are the terms and conditions. When we get cash down payment, then we, whether asset was purchased in the name of the hire purchase leasing company, it was properly registration certificate in their name, it was properly installed, insured, valued, then whether proper installments are recovered, are they accounted as per AS and Ind AS. Okay, if there's a default, then we will take back the possession, it should be repossessed. Finally, at year end, if required, it should be classified as NPA and provision. If there's a default, we go for NPA and repossession. Simply go and check this. If you want to do audit of a hire purchase company or leasing company, go through MOA, go through their whether the proposals are received, creditworthiness was evaluated, BOD approved things, agreement documents were prepared, cash down was received, asset was purchased in your own name, then it was registered, and then it was installed, insured, delivered, properly valued, then you get installment, properly accounting. If there's a default, then it is NPA and repossess the asset. That's how you do audit. The same points for hire purchase and lease. The only difference is in hire purchase, ownership is transferred. In lease, it is not transferred. But the points are on the same lines, guys. Exactly on the same lines. Now, guys, it is very important part. Audit report to board of directors. Sir, what is this audit report to board of directors? Apart from report on financial statements, regular report on financial statements, it's a specific thing which happens only in NBFC. It's a specific thing which happens only and only in NBFC. In NBFC, there are special audit report to board of directors directions 2016, and it says that a special audit report should be prepared exclusively for board of directors only. Okay. And if there is any adverse thing, then that adverse thing should be reported to RBI. Okay. Adverse thing should be reported to RBI. Only that adverse thing. That's called exceptional reporting. We'll discuss about it. So now what they have done is, guys, they have given the list. What matters to be reported for all NBFCs? Then what matters to be reported for NBFCs taking deposit? What matters should be reported for NBFC not taking deposits? And what matters to be reported for NBFC not supposed to get themselves registered? They are not going to ask all of them. Either they are going to say what matters to be reported for all NBFCs, or those taking deposits or not taking deposits are not supposed to get registered. It's a very simple thing, guys. Simply focus on the things which I am saying, that will be more than sufficient. You cannot learn and cram whole thing. Just get the flow, and you are supposed to explain in your own language. What matters should be included in this? What matters should be included in this report? Okay. For all NBFCs, we are supposed to first tell whether their principal business is finance as per the 50-50 test. Whether more than 50% of the income is finance income and more than 50% of the asset is financial asset. If yes, then next, whether they have taken proper certificate of registration. So we are supposed to report this to board of directors. Whether their principal business is finance as per 50-50 test. After that, if it's finance, yes, whether they have taken proper certificate of registration from RBI. Then, are they maintaining proper net own funds as required, that is minimum 2 crores, or as per any category higher than that? Very simple 3 things, and it is in flow, it is in sequence. Now, when it comes to net own funds, there is a very special point. It was asked in questions. Very special. There is a very special point, guys. So, what is this? This is a very special point. What is this special point? Okay. What is this special point? That after financial, every year, statutory auditor is supposed to send a certificate. About net own funds. shall submit certificate from statutory that it is engaged in business of NBFC required to hold certificate of registration, position of the company at the year end to regional office department of NBFC within 1 month of date of finalization, not later than 30th. So every year after finalization of financial statements, within 1 month, statutory auditor need to send a certificate, and it should not be later than the 30th December of that year, that whether their principal business is finance, are they having such a registration, are they maintaining net own funds, to regional office department of NBFC supervision. Every year auditor is supposed to send a certificate to these guys. So the first requirement is for all NBFCs. First report this thing in audit report to BOD. Apart from that, send a certificate to regional office of RBI. So we have to write these things in report to board of directors. Apart from that, we have to send a certificate to regional office of RBI. Now, NBFCs holding deposits. Guys, again, it is pretty simple. It's a flow. Whether they have gone for credit rating before raising deposit, point number 1. If they have gone for it, point next is, are they having MIGR? Sir, what do you mean MIGR? Minimum investment grade rating. All the rating agencies have different rating, like triple B, double B, B, okay, A, AA plus, triple A, and so on. So they specify this is the minimum rating which should be there, so that you can invest money in any security. Whether our NBFC has secured MIGR, whether it's a minimum MIGR or more than that. So first, whether rating was done, whether they have achieved MIGR or more than that, then what is the limit of deposit as per credit rating, whether deposit raised are within the limit. It's in sequence, guys. First, whether they went for credit rating, then is it MIGR, then limit as per credit rating agency. Okay, as per credit rating agency, what should be the limit? Is it within the limits? If they cross the limit, whether certain deposits were repaid and it was brought within the limits. Once they take the deposit, they need to compute and maintain capital adequacy ratio. We have discussed 15%. They need to maintain liquidity for repayment of deposits. Then they are supposed to pay regularly interest on the deposit. End of the year, they need to ensure compliance with the prudential norms so that they are safe and secure. End of the year, they are supposed to send return of deposit to RBI. They are supposed to send quarterly report. to RBI. So, end of the year, end of the quarter, they are supposed to do that. Apart from that, we need to specify that whether there was any violation. See, the complete thing was in sequence, guys. Sequence makes it very easy. Rating, then whether they got MIGR, what is the limit? Is it within the limit? Are they regularizing within the limit? Then after that, are they maintaining capital adequacy, liquidity, whether they are paying interest regularly, they are complying with prudential norms year end, return of deposit, quarter reports. Then whether there is a non-compliance, and are they opening branches as per the directions? Both are connected. Opening new branches. You open new branches, you are going to new public. It should be as per RBI directions. So points for all the NBFCs, point for accepting or not accepting deposit. Whether board resolution was passed for it and it is complied with, there should not be comment whether there was acceptance of deposit. First, board resolution was passed, whether there was acceptance of deposit throughout the year. It's very important for such category to get properly classified. Depending on the asset size and nature of activity, is it properly classified? Check that. Is it systematically important? If it is 500 crores or more, it becomes systematically important. If it is systematically important, there are more requirements. About the capital adequacy ratio should be there. An annual statement for capital funds. If it's systematically important, capital becomes extremely important. Capital adequacy ratio should be maintained, capital should be maintained, and inform about the capital. Then again, they are also supposed to maintain, they are supposed to follow prudential norms, comment on it, they are following prudential norms. Okay, are they following prudential norms? Then the next point is NBFC not supposed to have certificate of registration. Simply comment whether they fall in category where registration is not required, whether they have confirmed it with by RBI, they have sent the application, got the intimation advice from RBI that yes, you don't need to get registered. See that. If you are going to put qualification, any adverse negative remark, always give reasons. So these are matters which are divided into 4 heads. Exception reporting has been asked in questions. If at any point, guys, we don't need to remember and cram everything, write in your own language. In case if anything, while making report as per this direction, if there any point on which we are supposed to make adverse report, negative report, unfavorable report, all the points on which we are supposed to make negative report should be compiled at one place and it should be sent to directly to RBI. We are not supposed to inform them about all the points, only compile the negative points and only tell the negative points. That is called exception reporting. That is called only exceptions are reported. No need to remember so many rules and regulations. Okay, only unfavorable things, no need to talk about the favorable thing, regional office, only contravention, keep that in mind. Caro, we have discussed, guys. Next is impact of Ind AS. Now, from 2018, listed NBFCs are supposed to follow Ind AS, and unlisted NBFC 500 crores or more, again they need to go for Ind AS. From 2019, all listed from 2018, listed and unlisted NBFCs having 500 crores, net worth 500 crores or more, we are supposed to go for Ind AS. From 2019, all remaining unlisted entities and all unlisted entities having net worth, first cover all remaining other listed entities, and then when it comes to unlisted, cover more which are having 250 crores or more. Even for them, Ind AS will get applicable. Okay, and we have to see the net worth as per standalone financial statement as on 31st March 16. So that as on 31st March 16. Okay, for the existing entities, for new NBFCs, it will be last audited financial statements. Now the format, we know that in Schedule 3 there are 3 divisions. Division 1 is if you want to prepare financial statements as per accounting. If accounting standard is applicable to company and you have to prepare financial statement, Division 1 is applicable. If Ind AS is applicable, Division 2 format is applicable, balance sheet P&L. If it's an NBFC, there is a Division 3 specially prepared for NBFC. Okay, what is different? What is so special in this Division 3? As compared to Division 2? What is so special? So first of all, classification. In normal companies, we classify current and non-current. Here we classify financial and non-financial. Financial and non-financial. So there's a difference in classification: financial, non-financial, current, non-current. Then the order in which things are classified. In normal companies, we keep fixed asset first. It is in order of permanency. First fixed assets, then investment, then current assets. In NBFC, it is reverse. It is in order of liquidity. The most liquid asset first, and so on. So the way classification is done, and after classification, the way ordering is done, it is different. Then material item disclosure is different, guys. In normal, we have the in normal companies, in as per Division 2, something which exceeds 1% or 1% of revenue or 10 lakhs, whichever is higher. 1% of revenue or 10 lakhs, whichever is higher, this is the limit. If any income or expense crosses this limit, it should not be put in the heading of others or miscellaneous. There should be a separate line dedicated for it. If something is exceeding 1% or 10 lakhs, which is has, there should be a separate line for it. There should be a separate line for it. There should be a separate disclosure for it. Okay. There should be a separate disclosure for it. Now, when we talk about NBFC, the same limit is 1% of total income. It is not whichever is higher. It is only 1%. It can be asked in MCQs. So the way this disclosure limit is set is different. So the way classification ordering is done different. The way material item disclosure it is little different. Separate disclosures. In NBFC, if money is receivable from LLP, director, partner, member, separate disclosure. That we have given money to some LLPs where directors are involved as members, partners, that need to be disclosed separately. Or trade receivable which have significant increase in credit risk or credit impair. So we need to specify, we need to have a separate disclosure if money is given to LLPs where directors are involved. If money is given to, if money is given and there is a increase in the credit risk, okay. So separate disclosures for trade receivables is there. Separate disclosures for statutory reserve is there. That is special thing in NBFC. Common point. NBFC also require disclose items comprising revenue from operations and other comprehensive income on the face of the P&L instead of part of notes. So these are common points, guys. Revenue from operations in both and other comprehensive income in both at the face of the P&L. So there are some differences and at the end there is a common point. Guys, listen to this lecture again and it will be all fine. If you like it, do subscribe for it and put your lovely comments. Bye bye everyone.